Tonight, what I want to do is to take a look at using moving averages, but specifically within commodity markets. Now, obviously, we've been seeing quite a bit of volatile activity of late within commodity markets. And I just want to take a look at how we can use moving averages within this environment to highlight trading opportunities, confirmations of trends, and just look at the general basics of moving averages and how we can use them. So basically, just to run through a few of the terms that I'll be using within the presentation tonight. A simple moving average is just a true moving average over X periods. So if you have a 10-period moving average, you're taking the last 10 closing levels, adding them up and dividing by 10. And that just gives you the simple moving average that moves with price action and effectively gives you the trend for the last 10 days. Another type of average is an exponential moving average. Now, this is where the calculation places much greater emphasis on the latest data. So it will weight the most recent data by relevance. And basically, that means that we will see slightly earlier turning points within moving averages to reflect movement in price. Now, this will be much more quicker than the simple moving average. And this is one of the reasons why we tend to use exponential moving averages more within the calculation for indicators and that type of thing where there's already a smoothing factor that slows the signal. So by using an exponential moving average, that tries to overcome that type of condition. Regarding the types of signals that we look for using moving averages, the golden cross is the bullish signal. Now, this is where the rising short-term average crosses above the rising longer-term average, depending on what that could be, a 10-period against a 20-period, 50 against a 200, but they both have to be moving, or both have to be rising in the same direction, and the shorter term crosses above the longer term to reflect a positive signal, confirmation of the uptrend, and the risk of that trend continuing. Now, the mirror image of this is the dead cross. This is the bearish signal. And this is where we see a declining shorter term average crossing below an already declining longer term average. Now, they have to be moving in the same direction for the golden and dead cross. If one is rising and the other is falling as they cross, it's a neutral signal. And we have to wait for further evidence to establish where the true directional risks and trending conditions are developing. You can also see a drawing together of moving averages. Now, this is where the shorter term average will move back towards the longer term average. And it almost as it appears in an uptrend, it finds support from the longer term average. And we see a turn higher and a reacceleration of that ongoing positive trend. Or within a downtrend, the shorter term average rallies back to the declining longer term average, and we turn lower, almost as if resistance is found, and we see reacceleration of the bearish trend. So this drawing together can develop after consolidations, but be an indication that perhaps that consolidation is now ending and that we're now set to resume the longer term trending condition of the market. We can also use moving averages to confirm the confirmation of the trending condition of the market. So for instance, if a short-term average is rising above a longer term, and we can extend this to any number of moving averages, 3, 4, or even 5 in some cases, as long as the shorter term is above the slightly longer term against the medium term against the longer term average, then that's confirmation of the bullish trending condition that's dominant within the market and the risk of that trend continuing. Same way in a downtrend, when the shorter term average is below and declining below the longer term averages, then that reflects the ongoing bearish trending condition. So let's take a look at this, an example. We've got a chart of silver here on a daily basis, together with a 10-period, or in this case, a 10-day moving average, which is the red line, and the 20-day moving average, which is the blue line. So basically, these are just smoothing out the 10, and 20-day trends within the market. So the direction highlights where those trends are developing. Now, we mentioned about the neutral signals where moving averages are moving in different directions when they cross. So for instance, we saw the 10-day declining 10-day cross below the rising 20-day. And again, here we saw the 10-day cross above, which was rising above the declining 20-day moving average. Now, these are neutral signals, and it means that we need to see further evidence of a confirmed trending condition within the market. But obviously, as we've already said, with the rising shorter term above the rising longer term, that in itself eventually is a confirmation of the ongoing positive trend, although the cross itself is a neutral signal and not useful to actually generating new trades. However, when we look at the green arrows here, we can see when the rising shorter term average, the rising 10-day, crosses above the rising 20-day. And this gives us confirmation of the ongoing positive trend. And with the red arrows, we highlight where the declining 10-day moving average falls below the declining 20-day moving average. And because we've been trading in a more aggressive downside bias within silver of late, then we've seen these more negative crosses, these dead crosses within the two moving averages, as triggering a more aggressive and prolonged downside move. So by using these types of signals, we can see the types of confirmation of trending conditions, ending of consolidations, and the risk of a resumption of the ongoing trend. Now, if we add a further moving average here, so we've added the black line, which is a 5-day moving average, together with the 10 and 20-day, and this is the current chart of copper that we're looking at, we can actually look at a trading technique that we can use moving averages for, together with price and the 3 moving averages. So the strategy basically uses the price action in relation to the short, medium, and longer term moving averages. So when price starts to break below the 20-period moving average and the 5-period is below the 10-period, then we have a negative signal and the risk of a more extended downtrend beginning to materialize. And as long as this setup continues, then that trend is set to be extended. When the 10-period then breaks below the 20-period, that's further confirmation of this downtrending condition, either giving us extra confidence holding the original position, or maybe even a signal to increase risk because we have confirmation of this ongoing downtrend set to continue. In aggressive strategies, we can use the 5-day or the 5-period moving average as a stop for part of the position. So if we start to see closes above the 5-period moving average, then the risk could be turning towards a more extended consolidation. So as I say, within aggressive signals and trading strategies, that type of movement would be a reason to close at least part of the position against the risk of a more extended recovery and consolidation be developing. However, if price then starts to break back below the moving average, the 5-period moving average, that's a signal of re-acceleration of the downside and potential to continue that ongoing trend. So for a less aggressive strategy, we may well use the 10-period as a full stop for the position. So throughout this downside move after the original sell signal, we're using closes above the 10-period moving average as the signal to stop the shorts out and look for either a more extended consolidation or a more prolonged bullish trend. And as the market then started to close above the 20-period moving average, we then started to see more positive themes developing. And then we started to see upside beginning to emerge. So if we look at the current moving average backdrops for commodity markets as we stand at the moment, there's been a bit of a mixture. When we look at silver, we can see that the most recent sharp upward recovery has seen a golden cross develop where the rising 10-day has broken above the rising 20-day. And that highlights a more positive trending condition and the risk of further upside beginning to materialize. It's a similar sort of development within gold, where we've seen, again, the break by the shorter term average above the longer term and the potential for a more extended recovery move. However, when we start to look at things like wheat, which has obviously got its own fundamental conditions dominating and the exports of grain coming out of Ukraine, hopefully, then the recovery has been much less. And we're still seeing more negative themes, more bearish trending conditions still evident within price action, reflected by the 10-period moving average still being below the 20-period moving average, and now both starting to fall. So within this setup, it's still looking as though moving averages are highlighting the ongoing downtrend and the risk for a more extended sell-off. Similar sort of picture in oil, where the rally has just sort of proved to be more of a consolidation within an ongoing downtrend. The 20-period moving average is held on a closing basis, and we continue to see both moving averages declining to reflect an ongoing negative trending condition. So it's a mixed bag at the moment for commodities from a moving average perspective. There are those where the potential for a more extended recovery developing are in place, but certainly you need to be aware of these setups that are still highlighting ongoing negative trending conditions and the risk of further weakness beginning to materialize unless we start to see a turnaround in the moving averages and the golden cross beginning to develop.